The global silver market just experienced a structural break that most traders don't understand yet. The implementation of what's being called the Greenland Tariff has severed critical connections between the world's two largest precious metals trading centers, creating market fragmentation that threatens the entire pricing mechanism that has governed silver trade for decades. This isn't just another policy change or temporary market disruption. This represents a fundamental alteration in how physical silver moves between continents, and the consequences are already reshaping market dynamics in ways that could permanently change precious metals trading. Understanding this crisis requires examining how global silver markets actually function through interconnected networks of exchanges, vaults, and logistics systems. Most people assume silver has a single global price determined by supply and demand. In reality, silver prices reflect complex arbitrage relationships between different geographic markets, with physical metal flowing constantly between regions to equalize price differences and maintain market efficiency. These flows represent billions of dollars in daily transactions. Trading firms employ sophisticated algorithms to monitor price differences. Even small discrepancies trigger immediate arbitrage responses. The London Bullion Market Association and the Commodity Exchange in New York represent the two dominant centers of global silver trading, handling over 70% of worldwide silver transactions. These markets maintained price convergence through sophisticated mechanisms called location swaps, financial instruments that allowed banks and trading firms to move silver between London and New York without actually shipping physical metal across the Atlantic. Location swaps process over $50 billion annually. Major banks maintain dedicated trading desks for these operations. The system operates 24 hours daily across time zones. Location swaps work by creating offsetting positions in different geographic markets. A bank holding silver in London could sell London silver while simultaneously buying New York silver for future delivery, effectively transferring their position across continents without physical shipment. This mechanism enabled rapid arbitrage between markets while reducing transportation costs and delivery risks associated with international precious metals movement. Banks typically execute thousands of these transactions weekly. Computer systems monitor price differences in real time. Profits margins often measure in mere basis points. The elegance of location swap systems lay in their ability to maintain global price unity while accommodating regional supply and demand variations. When London silver prices exceeded New York levels, arbitrageurs could profit by selling London positions and buying New York positions, with their trading activity gradually eliminating price discrepancies. This arbitrage activity required no physical metal movement, making it extremely cost-effective while ensuring global market efficiency. Professional traders call this electronic arbitrage. The system prevents price differences exceeding normal ranges. Market makers profit from maintaining price convergence. However, location swaps depend on regulatory and tax frameworks that treat these transactions as legitimate arbitrage rather than taxable imports or exports. The Greenland tariff implementation disrupted this framework by imposing 10% tariffs on precious metals financial instruments between the United States and European Union, including the United Kingdom. These tariffs don't directly affect physical metal shipments, but they make location swap transactions prohibitively expensive. Tax authorities classify swaps as financial transfers now. Compliance departments struggle with new regulatory requirements. Legal teams review every transaction for tariff implications. The tariff structure creates immediate costs that exceed normal arbitrage profit margins. Location swaps typically generate profits measured in basis points or small percentage amounts. Imposing 10% tariffs on these transactions eliminates profitability while creating substantial losses for market makers attempting to maintain price convergence between geographic regions. Banks and trading firms cannot absorb such costs while maintaining competitive pricing for their services. Risk management systems flag these transactions as unprofitable. Trading desks shut down location swap operations immediately. Back-office systems require complete reconfiguration for new rules. Within hours of tariff implementation, trading firms began suspending location swap activities between New York and London markets. Major banks that previously facilitated seamless arbitrage between COMEX and LBMA announced temporary suspension of these services pending policy clarification. The immediate result was growing price divergence between markets as normal arbitrage mechanisms ceased functioning. JP Morgan halted operations first on Tuesday morning. Goldman Sachs followed within 3 hours of opening. Bank of America suspended all European silver swaps. London Bullion Market Association silver prices began trading at discounts to New York COMEX prices as European demand faced reduced access to American silver supplies. Simultaneously, New York silver prices increased as American buyers competed for domestic inventory, while European silver became effectively inaccessible through normal trading channels. The price spread between markets widened from typical levels of a few cents per ounce to several dollars within the first week. London prices dropped $2 below New York. European dealers reported immediate supply shortages. American markets showed unusual price volatility patterns. Physical silver shipments between continents face different regulatory treatment than financial instrument swaps, but shipping costs, insurance requirements, and delivery timeframes make physical arbitrage impractical for small price differences. Physical shipment might make economic sense when price differences exceed $5 to $10 per ounce, but such large spreads indicate severe market dysfunction rather than normal arbitrage opportunities. Ocean freight requires minimum 2 weeks transit time. Air freight costs exceed most arbitrage profit margins. Insurance companies increased precious metals shipping premiums dramatically. The logistics of international silver movement involve complex procedures, including export licensing, customs clearance, transportation security, and delivery verification that can require weeks or months to complete. Financial markets operate in real time with instant price discovery and immediate settlement expectations. Physical arbitrage cannot provide the rapid response needed to maintain efficient price relationships between geographic markets. Export licenses require government approval in advance. Customs procedures create unpredictable delays at borders. Security escorts add substantial transportation costs. Banking institutions that previously provided market-making services between London and New York face impossible choices under the new tariff structure. Continuing location swap activities generates immediate losses from tariff costs. Suspending these services allows price divergence that undermines their market-making profitability in both markets. Many banks have chosen to reduce precious metals trading activities rather than operate under economically unfavorable conditions. Treasury departments calculate losses in millions daily. Senior management considers exiting precious metals entirely. Compliance costs alone exceed previous profit margins. The reduction in banking participation creates liquidity problems that amplify price volatility in both markets. Fewer market makers means wider bid-ask spreads, reduced trading volumes, and increased price sensitivity to individual transactions. Markets that previously absorbed large orders with minimal price impact now experience significant volatility from relatively small trading activity. Bid-ask spreads doubled within first trading week. Daily volume declined 30% immediately. Price volatility increased to unprecedented levels. Industrial silver users face particular challenges from market fragmentation because their operations require predictable pricing and reliable supply access. Electronics manufacturers, solar panel producers, and medical device companies typically hedge silver costs through futures contracts and forward purchases. Market fragmentation makes hedging more expensive while reducing contract availability, forcing industrial users to adapt supply chain strategies for higher costs and increased uncertainty. Procurement departments report supply chain disruptions immediately. Manufacturing schedules face delays from inventory shortages. Hedging strategies require complete revision for new conditions. Investment demand shows different patterns in fragmented markets as investors recognize arbitrage opportunities while simultaneously facing reduced market efficiency. Sophisticated investors attempt to exploit price differences between markets, but transaction costs and regulatory complexity limit their ability to execute profitable strategies. Meanwhile, retail investors face higher transaction costs and reduced liquidity that makes precious metals investment more expensive and less accessible. Hedge funds deploy capital to exploit spreads. Retail brokers increase minimum transaction sizes significantly. Investment advisors recommend reduced precious metals allocations. Regional central bank behavior reflects growing concerns about market fragmentation effects on monetary policy implementation. Central banks use precious metals markets for reserve management and currency intervention activities that require efficient price discovery and adequate liquidity. Fragmented markets complicate these operations while creating uncertainty about asset values that affects monetary policy effectiveness. Federal Reserve monitors market conditions daily now. European Central Bank considers alternative reserve strategies. Bank of England reviews precious metals policies. The European Union's response to the Greenland tariff involves developing alternative trading mechanisms that could permanently change global precious metals market structure. European officials have announced plans for expanded silver trading capabilities at European exchanges, combined with direct bilateral arrangements with Asian and Middle Eastern markets that bypass American trading systems entirely. Brussels allocates emergency funding for market infrastructure. European Parliament schedules hearings on trade impacts. Commission prepares retaliatory measures against American policies. Asian precious metals markets, particularly Shanghai and Hong Kong exchanges, are experiencing increased trading volumes as global investors seek alternatives to London-New York arbitrage relationships. These markets offer different regulatory frameworks and trading mechanisms that could absorb activity displaced from traditional Western markets. However, Asian markets operate under different time zones, settlement procedures, and regulatory oversight that create additional complexity for global trading operations. Shanghai Gold Exchange reports record volume increases. Hong Kong Mercantile Exchange expands trading hours significantly. Singapore considers new precious metals contracts. The Shanghai Gold Exchange has announced plans for expanded silver trading capabilities designed to serve international markets seeking alternatives to Western trading centers. Chinese precious metals markets already handle substantial domestic volumes but face regulatory and currency conversion limitations that restrict international participation. Expanded international access could reshape global precious metals trading geography while creating new dependencies on Chinese financial infrastructure. Chinese authorities approve foreign participation rules rapidly. Yuan-denominated contracts gain international acceptance gradually. Beijing promotes alternative trading mechanisms actively. Middle Eastern precious metals markets, particularly Dubai and Saudi Arabia, are developing enhanced trading capabilities that could serve as intermediate options between Asian and Western markets. These markets offer advantages including strategic geographic location, established trading infrastructure, and regulatory frameworks designed to attract international financial activity. However, they currently lack the volume and liquidity necessary to replace London or New York market functions. Dubai Multi-Commodities Center expands precious metals facilities. Saudi Arabia plans new exchange operations. UAE relaxes foreign investment restrictions. The timing of the Greenland tariff implementation coincides with other global trade tensions that compound market fragmentation effects. Existing tariffs on various commodities and manufactured goods already create trade flow disruptions that affect precious metals supply chains. Additional tariffs on financial instruments create compounding effects that further reduce market efficiency while increasing costs for all market participants. Trade war escalation affects multiple commodity sectors. Supply chains require emergency reorganization across industries. International cooperation declines as tensions increase. Currency market volatility adds another layer of complexity to fragmented precious metals markets. Exchange rate fluctuations between dollars, euros, pounds, and other currencies affect relative precious metals prices in ways that normal arbitrage would typically offset. With arbitrage mechanisms disrupted, currency movements create additional price volatility that makes precious metals investment and hedging more difficult across all markets. Dollar strength creates European purchasing disadvantages. Euro weakness compounds London market problems. Currency hedging becomes essential for international traders. The insurance industry faces challenges from precious metals market fragmentation as policy coverage for international trading, transportation, and storage becomes more complex and expensive. Insurance companies must reassess risk models that assumed efficient global markets with predictable arbitrage relationships. Higher insurance costs add to the overall expense of precious metals trading while reducing market accessibility for smaller participants. Lloyd's of London reviews precious metals policies. Marine insurance premiums increase substantially for shipments. Political risk coverage becomes an essential requirement. Legal framework complications arise from market fragmentation as contracts written assuming single global prices face disputes over which regional price applies for settlement purposes. Existing futures contracts, option agreements, and forward purchase arrangements may require legal interpretation to determine appropriate pricing references when global price unity no longer exists. Contract disputes multiply as markets fragment. Legal departments prepare for extensive litigation. Arbitration services experience unprecedented demand. Professional trading firms are adapting to fragmented markets by developing separate trading strategies for different regional markets rather than relying on global arbitrage opportunities. This adaptation requires additional capital allocation, risk management systems, and operational infrastructure that increases costs while reducing overall trading efficiency. Some firms are choosing to exit precious metals trading rather than adapt to increased complexity and reduced profitability. Proprietary trading desks restructure operations completely. Risk management systems require expensive upgrades. Technology infrastructure needs substantial investment. Retail precious metals dealers face inventory management challenges as regional price differences affect customer behavior and supply chain economics. Dealers must choose whether to offer regional pricing that reflects local market conditions or attempt to maintain national pricing that may not reflect actual costs and availability. Either choice creates customer confusion while potentially affecting dealer profitability. Local coin shops report customer confusion. Online dealers implement regional pricing systems. Inventory turns become difficult to predict. The storage industry experiences increased demand for precious metals vaulting services as investors seek regional storage options that reduce exposure to international transportation risks and regulatory complications. Vault operators are expanding capacity while adapting security and insurance arrangements to accommodate changed market conditions. However, increased storage demand creates capacity constraints that drive up storage costs for all users. Vault construction accelerates across major cities. Security companies expand precious metals services. Storage waiting lists develop at premium facilities. Technology solutions are emerging to help market participants navigate fragmented precious metals markets through enhanced price discovery systems, trading platforms designed for multiple regional markets, and risk management tools that accommodate increased complexity. However, technology implementation requires time and investment that many market participants struggle to accommodate during period of rapid change. Fintech companies develop specialized trading platforms. Price aggregation services become essential tools. Blockchain solutions gain interest for settlement efficiency. Regulatory arbitrage opportunities develop as different jurisdictions maintain different approaches to precious metals, taxation, trading regulation, and market oversight. Sophisticated market participants may benefit from jurisdictional shopping, while smaller participants face increased complexity and compliance costs. These regulatory differences could accelerate market fragmentation while creating competitive disadvantages for markets with more restrictive frameworks. Tax havens attract precious metals trading operations. Regulatory competition intensifies between financial centers. Compliance costs vary dramatically across jurisdictions. Academic research institutions are studying market fragmentation effects to understand long-term implications for global financial stability and monetary policy effectiveness. Early analysis suggests that precious metals market fragmentation could affect currency stability, inflation measurement, and central bank operations in ways that extend beyond immediate trading impacts. However, comprehensive analysis requires time that may not be available before policy responses become necessary. Universities launch emergency research programs immediately. Economic models require fundamental revision for fragmentation. Policy papers multiply across academic institutions. Congressional oversight of the Greenland tariff implementation faces technical complexity that limits effective policy evaluation. Most political officials lack detailed understanding of precious metals, market structure, and arbitrage mechanisms necessary to assess policy consequences. This knowledge gap complicates policy adjustment processes while potentially allowing problems to develop without adequate oversight or correction. Congressional hearings schedule precious metals experts. Policy briefings become essential for lawmakers. Technical complexity challenges political understanding. International coordination becomes essential for addressing market fragmentation effects, but political tensions that created the original tariff implementation complicate cooperative responses. Countries may prioritize domestic market protection over global market efficiency, creating incentives for continued fragmentation rather than cooperative solutions that restore market unity. G20 meetings address precious metals disruptions. International Monetary Fund monitors market developments. World Trade Organization considers formal complaints. The timeline for market adaptation depends on whether current fragmentation represents temporary disruption during policy transition or permanent structural change requiring new trading mechanisms. Market participants are making investment and operational decisions based on their assessment of permanence, but uncertainty about policy direction complicates long-term planning while potentially creating suboptimal market structures. Planning horizons shorten dramatically under uncertainty. Capital allocation decisions face extreme difficulty. Strategic planning becomes nearly impossible. Emergency policy responses could include tariff exemptions for financial instruments that maintain market arbitrage while preserving tariff effects on physical goods, bilateral agreements that restore specific trading relationships, or multilateral frameworks that address trade tensions without fragmenting financial markets. However, each policy option involves political and economic trade-offs that complicate rapid implementation. Emergency sessions convene in Washington immediately. European officials prepare counter-proposals urgently. Asian governments monitor developments closely. The precedent established by precious metals market fragmentation could affect other commodity markets if similar tariff structures are applied to agricultural products, energy commodities, or industrial metals. Understanding precious metals market responses provides insights about potential consequences of trade policy extensions while highlighting the interconnected nature of global commodity trading systems. Copper markets show early fragmentation signs. Agricultural futures face similar risks potentially. Energy markets prepare for possible disruption. Long-term market evolution may involve development of entirely new trading mechanisms designed to operate efficiently in fragmented market conditions. These mechanisms might include enhanced regional exchanges, alternative arbitrage systems, or technological solutions that reduce dependence on international coordination. However, such developments require substantial time and investment while potentially creating less efficient outcomes than unified global markets. Innovation accelerates under pressure from fragmentation. New business models emerge rapidly. Market structure evolution becomes inevitable. This analysis examines observable market developments following policy implementation rather than advocating for specific policy responses or predicting exact outcomes. Market fragmentation creates complex dynamics that affect different participants differently, while potentially requiring extended periods for full consequences to develop. Understanding these dynamics provides context for evaluating current market conditions while recognizing the uncertainty inherent in structural market changes during periods of trade tension and policy uncertainty.